Hi everybody, and welcome to today's episode of Does It Work?, where I explore trading strategies and just kind of do some testing to see if it works. Below we have the accumulation distribution indicator, and you can see the math for it down there. And we're going to just test a really basic strategy based on that indicator, and we'll see how it goes. So the trading rules are pretty simple. I'm going to highlight them here for you so you can read them. It's the indicator is better than the 3-day exponential moving average of the indicator, so it crosses above its own exponential moving averages when you buy, and you sell when the opposite happens. So you can see this is just a trend following strategy where, normal trend following strategies, you don't win as much as you lose, but the losers aren't as big as the winners, and the winners are supposed to make up for the losers. So we're going to backtest this here on the DIA ETF and just see what it does, make sure we're getting results, and make sure the strategy is doing what we think it's doing in the test. And right off the bat here, you can see it just loses a bunch. So right off the bat, we know this probably doesn't work too well. As you can see, the winners don't happen as much as the losers do, but the winners don't make up for the money lost in the losers. So nice, a dead strategy, but let's keep going. We'll look at the charts here. 2000 to 2008 didn't do much. 2008 just got absolutely slammed, and you can look at down here. Lost 48.6% in 2008, so probably not something I would trade. Anyway, let's keep going here. Let's now that we know that it's kind of getting trades, and we can look at them and see if it's taking the trades that we're thinking it's taking or should take. I'm gonna look at the chart here just to make sure. Got the arrows for the trades, and when this orange line crosses above the blue line, we need to. So the next day needs to take a trade long, so it does. So it looks like I've coded it right at least. That's good. And then it sells when the opposite happens, and it does. So we know the code's right anyway. You can see where someone will get an idea for this to happen. You can see where the trend kind of does happen, and it does make a decent gain there between April and May, but it just doesn't do it enough. So anyway, now that we know it's working as we thought it was, let's go and instead of testing just the one ETF here, let's test the Dow 30, all 30 stocks in the Dow Jones Industrial Average. And we're going to take our account and 30 positions. We'll make it $833.33 just to make it close to the $25,000 account size. And we're going to change. Let's save it here. Check it. Okay, it all works. Our syntax is good anyway. We're going to change this to a filter. And we're going to select a watch list. I'm using Norgate Premium Data. This is the alpha version, up to the Dow Jones Industrial Average. And we're going to backtest it against that and see what happens. All right, and as it's backtesting here, I'll say this is AmiBroker. This is actually happening in real time. It's pretty quick at testing these things. So here we go. And of course, we know it's going to lose, and it does a lot, 82.41%. And let's look at the chart here. It's just a steady decline with a big fall off a cliff there in 2008. So I know all of you are thinking, survivorship bias, it's got to be worse than that. And, well, yeah, you're probably right. So you see, this is the Dow 30 from, now, which isn't the Dow 30 from, from 2000 to 2012. So one of the nice things that the Alpha database here has, or Norgate's database has, is a function called isIndexConstituent. And I'm going to type that in and make it the Dow Jones Industrial Average. And then I'm going to go back and check my code here. And we got to save this. And I got to change my watch list. Instead of the Dow 30, I got to go to the historical constituents, where instead of 30 symbols, there's 98. So now it's going to test against all the old Dow components when they happened, which is pretty neat. Gets rid of a little survivorship bias, and results usually aren't as good, which you can't get much worse with this one, honestly. So here we go. It's thinking about it. There it is. Let's look at the stats. Yeah, down 91%. So, yeah, there was some survivorship bias even in that bad thing. You can see it very clearly here. But here's the symbols where all these symbols with numbers after them are former Dow components. And, so now you start thinking, there's something tests this bad. Maybe just doing the exact opposite instead of a trend-following system, making it a mean reversion system might be something to explore. So let's go ahead and do that. And basically, it's just I'm going to change my alligator mouse to go the other way, and that'll make the rules exactly the opposite of each other. And let's test this. I mean, mean reversion systems generally win more than they lose. They're the exact opposite of a trend-following system, pretty much. So we'll see. Yeah, everything looks good here. Hit our back test button, let it go. And yeah, a lot more green, so we'll see what... Okay, yeah, so yeah, 107% over that period of time. Not really that great, though. 63% winners, 36% losers. And yeah, and mean reversion strategies, they're tough. I mean, if you got 63% winners, it probably won't trade very well in real time. I like to see 75 or 80%. Good equity curve, though. You see it still loses in 2008. A little dip down there. But this is more to my liking. I do like the lot more winning than losing. It's just me. So let's do a little walk forward test. I will do one real quick and speed it up. And if you don't know what walk forward testing is, you can Google it. It's just a way of getting out of sample data in these tests to make it a little more realistic. And here we go. I'm speeding this up. This test actually takes about 3 minutes, but I know no one wants to watch that. So you can see the in sample and out of sample. The out of sample is usually less than the in sample, but then it concatenates everything into this. Still made 102% out of in the walk forward testing, and still a big dip around 2008. So yeah, that's to be expected. And we'll look at the charts a little bit more here. Yeah, definitely a mean reversion strategy. As you can see, the numbers go 64.61% winners. This whole test does include commissions, by the way. I'm not doing this without adding in commissions, and it's roughly Interactive Broker's commission schedule. So it's not a lot, but it is realistic. Yeah, we just paid like $8,700 in commissions or something for that. So let's see if we can take that little bump out by adding a short side of this strategy. So let's see. Short and cover rules are pretty much going to be the opposites of the sell and buy rules, or the buy and sell rules. So we'll just make them the opposite. See, copy and paste these things down real quick. There we go. Add my semicolon. Check everything. Yep, looks okay. Save it. Yeah, see, now we have a back test going. Let's hit back test, and we're going to make sure it's actually taking short positions and long positions rather than just long only. So yeah, long and short, it's doing both. Equity curve, it does get a little bit better. Of course, it's back in sample too, so it's pretty neat. Look at that, 2008, you can tell where the short positions helped out a bunch. Instead of having it go down, it actually goes up a bunch, which pretty interesting. Once again, this is probably a strategy I wouldn't trade, but it's interesting to do. And yeah, 62% winners, 37% losers with the shorts added in there. Just kind of smooths everything out. Anyway, that is this episode of Does It Work? And I'm pretty sure we answered that question. So I hope you enjoyed this. And if you think I can do something better, if you like it, hate it, just want to make fun of me, please post a comment. And thanks for watching. And hope to see you next time. Thanks.